So in today's video, we'll learn about what is EPS or earning per share. So among the fundamental analysis tools, earning per share is one of the most popular tools. It is the term which is very important to the investors and stock market players. This term gives a clear picture of a company's stock value to a maximum extent. Earning per share are the proportion of the profit which is allocated to each share of the company. It is calculated by dividing the total profit of the company by the total number of outstanding shares. Earning per share of a company are higher means the profitability of the company is better. Earning per share can be calculated in two ways. EPS, which is equal to net number after tax or total number of outstanding share, and weighted EPS, that is net income after tax, total dividends or total number of outstanding shares of a company. Weighted EPS is advisable to calculate while calculating EPS because the number of outstanding shares changes over time. You must compare one company's EPS to another in the same industry so that you can get an idea that which company is better to invest. But only calculation of EPS is not enough to know about your stock's value and what market think about your stock. You should calculate some ratios also for this purpose. Types of earnings per share are as follows. Trailing EPS. This is the EPS of the most recently completed fiscal year of the company. It is the actual EPS. Current EPS. This is the EPS of this fiscal year, which is a projected EPS. Forward EPS. This EPS of next fiscal year, which is obviously a projection. So these types helps you to know about a stock and compare it with its peers. So let us discuss about why EPS is important. The earnings per share metric are one of the most important variables in determining a share's price. It is also a major component used to calculate the price to earnings, which is PE valuation ratio, where the E in P by E refers to EPS. By dividing a company's share price by its earnings per share, an investor can see the value of a stock in terms of how much the market is willing to pay for each dollar of earnings. EPS is one of the many indicators you could use to pick stocks. If you have an interest in stock trading or investing, your next step is to choose a broker that works for your investment style. Comparing EPS in absolute terms may not have much meaning to investors because ordinary shareholders do not have direct access to the earnings. Instead, investors will compare EPS with the share price of the stock to determine the value of earnings and how investors feel about future growth. So now let's see how we can use EPS in the fundamental analysis of stocks. Fundamental analysis of stocks is a method of looking into the basics or fundamentals of a company at its financial level. The ratios which are calculated from these financials are helpful in determining the health and growth prospects of the company. Also, it gives you an idea about your stock. If you want to do fundamental analysis with the combination of other tools, you have many other tools also which will help you to evaluate your stock. These tools tell you your stock's value without going into an in-depth analysis of a stock. The main aim of investors is to know that what market is giving value to their stock. And by going through fundamental analysis in different tools, you can easily know that. Earnings play a vital role in the analysis. Earning is profit and investors want to know that what profit a company is making because earnings help a stock to earn value in the market. If a company has good earning, then the price of the stock is possibly high and vice versa. Also, a good profit-making company gives a good and regular dividend to its investors. Only earnings don't tell you about the stock's value. So you need to go through different fundamental analysis tools which help you know that what market is valuing your stock. So as I said earlier, EPS measures the profitability of a company on per share basis. Let us understand this using an example. Assume a certain company with 1,000 shares outstanding generates a profit of rupees 2 lakh. Then the earnings on per share basis would be 2 lakhs divided by 1,000. That will be equal to rupees 200 per share. Hence, the EPS gives us a sense of the profits generated on a per share basis. Clearly, higher the EPS, better it is for its shareholders. Now, let us understand the limitations of earnings per share. When a company's earnings increase, it is an indication that the company is doing well financially and that it's potentially a worthwhile investment. But as a measure of a company's financial health, the earnings per share calculation has its limitations. Because companies have the options to buy back their own shares, they can improve their earnings per share by reducing their number of shares outstanding without actually increasing their net income. In this regard, companies can essentially manipulate investors into thinking they're doing better than they actually are. Furthermore, earnings per share does not take factors such as a company's outstanding debt into account. Finally, earnings per share does not consider the capital needed to generate the earnings in question. If two companies report the same earnings per share, but one uses less capital to bring in that income, that company is probably managing its resources better than its counterpart. However, that fact wouldn't be reflected in its earning per share. So put this information to good use and get started investing today. You can visit our website StockQuantum.com for more information. Thank you for watching.